Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. The market macro event. Prepare for those NVIDIA earnings to deliver records and volatility. Banking blues. Warren Buffett bails on Bank of America. HSBC mulls management layoffs. And a new chapter in the election race. U.S. Special Counsel presses on with an updated indictment against former President Donald Trump. It is the very personification of risk, and you'll make sure that you've got this stock in your account. If you didn't have it on that sort of nadir in October 2022, you've missed 1,000% rally. That is what is at play. What does it take for NVIDIA to deliver a momentum like that again? Something pretty darn hot. $3 billion worth of a market move is what the market is expecting today, according to the options market. Potentially 10% either side. There's 66 buy ratings on this. 90% of the analyst community have a buy rating on this. Are there delays? We'll talk more about what is behind the NVIDIA record EBITDA, earnings and revenue that we expect for the second quarter, and what might it mean for buybacks. This is a company that is throwing off cash. Let me just give you a glimpse at what's under the hood of risk today, because this is the macro moving event for really the rest of the sentiment. NASDAQ up 1/8%. Consumer confidence in the United States is at a 6-month high, which is adding to the momentum overall here and the overall soft landing narrative. Yields drop ever so slightly. What you're looking at here is, of course, the 2-year paper went fine. Yes, yeah, the bid to cover ratio was a little bit lower than the last 2 auctions, but certainly above the recent ones. The heavy hitters from New York and Chicago, that's John Williams and Austin Goolsbee, both voted for rate cuts in July. Now, you can call them the swing voters, you can call them the heavy hitters, but either way, those two protagonists were out there calling for cuts. A little bit of a turnaround. You've got the dollar-yen moving this morning. The Bank of Japan's Himino says the first job is to monitor markets closely and with a sense of urgency. So if you think that intervention risk from the Bank of Japan has gone, you are very, very much mistaken. Now, as I said, the Fed presidents John Williams and Austin Goolsbee voted in July in favor of lowering the discount lending rate, signaling they were prepared to support a cut last month. My guest this morning is Gurpreet Garewal of Goldman Sachs Asset Management, and she writes this. Interestingly, the Fed and the market appear to agree on where the policy rate will end in 2025. However, the market anticipates more front-loading of those rate cuts in the coming months. She joins me now. So good to see you this morning. So we have this, a sense of agreement on the destination, but it's going to be a heck of a bumpy ride to get there. How significant, let's just square away the top line this morning. How significant is it that New York and Chicago presidents actually voted for a cut in July? They are the swing, they are the heft, they are the shakers and the movers at the Fed.
Hi, Manus. First of all, great to be with you. Look, I don't think it's surprising that we did have Fed officials that were inclined to be supportive of easing back in July. And there's always going to be diverse opinions on these sort of committees at central banks. I think the reason why we didn't see a cut back then is that the Fed hadn't guided to that. They didn't want to unnerve the market and alarm the market. Since then, we have had more data. The Fed has been able to accumulate more confidence in the case for easing, and it's very clear in all the Fed rhetoric that we've received over the past week or so, including Chair Powell's Jackson Hole address. There is less concern about inflation, there's more concern about the labour market, and there is limited tolerance for any further weakening in the labour market, which would be, quote, unwelcome. So I think it's very clear that we are going to see the Fed initiate that cutting cycle in September. And I think the key question is the magnitude or the pace of that easing. And the key determinant for that is really going to be what we see happen in the evolution of the labour market.
And you know, in your learning from the earnings, and I know that that's the title of part of the research, the learning from the earnings is that, you know, there's minimal talk about layoffs. You know, it's not high on the agenda, and it's not showing through on many of the data pieces either.
Yeah, exactly. That's a great point. What we've seen is that companies are no longer discussing labour shortages. And so that does indicate that the labour market is in better balance. It corroborates a lot of the macro data that we see. And we here at Goldman Sachs Asset Management love to marry the micro and what our corporate credit and equity analysts are saying with the macro and what our US economist is saying. And that is supportive of that macro disinflation story. But at the same time, you're not seeing a sharp uptick in the number of companies discussing layoffs, that's actually low. The number of companies discussing recession is also low and contained. And actually, sentiment on the consumer improved in the latest quarterly earnings reports. And so I think the signal from corporate America is relatively constructive on the economy and is supportive of an ongoing expansion.
But the movement that we've seen in some of these bond markets, it's acted as a hedge, it's a geopolitical bolstering, but you are still a protagonist of the steepener overall. So just how much breath is left in that trade? Once we get going with the assumed cuts in September, which I know you're going for 3 clips of 25 basis points in the back quarter, which is a little bit lighter than where the market thinks at the moment.
Look, I think we have some sympathy with what the market is pricing. What the market is pricing for the next 5 meetings is some probability of the prospect of a 50 basis points rate cut. We think that seems reasonable. I think right now, the data and what we see in the labour market is supportive of a string of 3 25 basis points rate cuts. But we do think that there is a low bar for that to be increased to a 50 basis points rate cut at one of the upcoming meetings, including potentially September, should we see any signs of further weakness in the labour market. Chair Powell and other Fed officials have indicated that. And I think, big picture for investors, what we think is important to keep in mind is that we do anticipate around 200 to 250 basis points of adjustment in the Fed's policy rate over the coming year. That is supporting of steepening exposure. But at the same time, you're seeing, inflation is in check. The labour market is loosening, not collapsing, and the Fed is clearly committed to elongating the expansion. In that environment, in that regime, when the credit fundamental picture is still solid, we still want to be earning attractive rates of income on sectors like corporate credit, securities credit. But at the same time, we've moved to this regime where downside growth risks are dominating upside inflation risks. And so you probably want to balance risk asset exposures with bonds. We have seen bonds have been able to deliver that stability sort of factor in recent growth concern wobbles. We saw it in the regional bank crisis last year. We saw it earlier this month as well. And so we think it makes sense to retain risk asset exposure, but also balance that with bonds.
And look, obviously, I know that you've thrown in there that you could get a 50 basis point cut in September. Many people are saying, look, if they do that, it's a sign of something much more malevolent coming down the pike that perhaps that we don't see, but it's not necessarily your base case. Can we just touch on the other risk, which we've now all decided has gone to dust, which is inflation? And this is a debate I've been having over the past couple of days. The five-year forwards, nicely drifting lower. My guest yesterday were saying, look, there's still a risk that you could have a resurrection of inflation next year. The growth scare is very, very clear there at the beginning of August, the drop in the break-evens. So as a house at Goldman Sachs Asset Management, you don't see any indicators of the risk of inflation reasserting itself in 2025. It's a dragon that's been vanquished, is it?
Look, as economists, we've been incredibly humbled during this pandemic era, and so we can't ever say no to any potential scenario. And so we're always alert to upside risks to inflation. A few things that I would make is, look, we now have more clarity on what the drivers of that inflation shoot were. There was uniform price increases. There was a change in inflation psychology, change in wage demand, corporate price setting behavior. We've now seen that in earnings reports, actually coming back to the learnings from earnings. Companies are indicating less pricing power. They're trying to increase their bottom line through greater sales rather than increasing prices. At the same time, core goods is experiencing deflation again. That's back to what it was pre-pandemic. You're seeing wages normalize, inflation expectations in check. That should support further slowing of services inflation. And so all of these dynamics and, our proprietary indicators do corroborate that. They do support normalization in inflation. That's not to say that inflation is going to return to the low inflation regime of the last cycle. We are in an environment where there are structural forces, reshoring, uncertainty in supply chains, etc., that does argue for a higher inflation regime, and as a result of that, a higher rate regime. But ultimately, that's opportunistic for fixed income investors.
Gurpreet, thank you so much for being with me this morning, keeping an eye on the steepness and hunkering down for the September rates meeting. Gurpreet Garewal of Goldman Sachs Asset Management. Other stories trending on your Bloomberg terminal this Wednesday morning. This is what we've got for you. Apple, they're cutting about 100 jobs in the digital services group. The biggest layoffs will be in the teams handling Apple Books app, the Apple Bookstore. Apple Books has become less of a priority for the company. NFL owners loosened strict ownership rules and voted to allow private equity firms to buy stakes in their franchises. The move is expected to attract billions of fresh capital and boost team valuations. Actus partners Ares and Sixth Street are among the firms approved to buy stakes. UK homes up for sale hit a 7-year high. That's according to a report on the property website Zoopla. Sellers are growing more confident about finding the buyers that borrowing costs are about to ease. And coming up, the main event of the day, NVIDIA, the drum beats. It's heard across Wall Street and beyond. The results matter. We bring them to you live on Bloomberg. It is Bloomberg Brief. I'm Manus Cranny in New York. It is all about NVIDIA. The stock is steady this morning ahead of the earnings that are set to come out after the market close. That's on the back of a 160% rally this year. Let's bring in our Bloomberg Intelligence senior analyst, Robert Lee. He joins me now. Robert, look, there's a number of portions in this report that we're going to focus on, but we are expecting records on multiple fronts, and that is driven by the data centers.
Yeah, how many quarters in a row have you said that for, I wonder? But no, absolutely another blowout set of numbers expected. My colleagues in the US who lead coverage are expecting yet another beat and raise. So let's take that for granted. I don't think the numbers or the guidance into next quarter should cause too much disruption. But a bigger question is really the rate of monetization within their hyperscale customers, and also the nearer term issue of this Blackwell production delay. So I think those are the three areas to look at into these numbers later on today, your time.
For anybody who's not familiar with the language of NVIDIA, what is Blackwell? Why would a delay matter in that product area?
Okay, without going to Mickey Mouse terminology, it's a really big, complex chip made, at the cutting edge, literally a few atoms out here or there, the thing won't work. So there have been, you're working at the cutting edge of semiconductor technology, working closely with its production partner TSMC in Taiwan. So there have been some delays, which I think is an inherent risk when you're working at the bleeding edge. But ultimately, once that chip is into production next year, that will drive their revenue. So it's a key new product driver for the business into next year.
Look, during this quarter, on the reporting of some of the big users of NVIDIA's product, we were obsessed by the amount of capex that they were spending and whether that was being reduced. But the other thing we've talked a lot about is the moat. In other words, the defense around NVIDIA in regards to competition. You're pretty brilliantly placed in Hong Kong to give us a read in terms of China and Greater Asia in terms of that threat to the moat of NVIDIA. Is there anything that come near to challenging NVIDIA? Or how much of a threat is China to NVIDIA?
Okay, just very briefly divide things into the world of hardware and software. So obviously NVIDIA is a leading semiconductor company dominating the supply of specialist chips. Obviously, its increasing level of geopolitics is impacting their business. So that protective moat, as you've said, is actually increased because equally, whilst NVIDIA is finding it more difficult to sell their chips into China, equally the Chinese can't sell. And also, I think it's well known in the market that the Chinese are several generations behind, with things made more challenging for them, given the export restrictions on ASML production equipment. So they can't access leading edge semiconductor fabrication equipment. But on the software side, very briefly, I think the technical barriers to entry there are much lower. Chinese companies are doing quite well, but their models are mainly based within the world of Chinese language, focused on Asian markets, and I don't think that's a major competitive threat to the major US companies. So these two sides of the world are operating in very distinct and separate markets at the moment, and I think that will continue for the foreseeable future.
Yeah, I don't think it matters who's going to be in the White House. It's not as if we're going to have some massive rapprochement. Well, interesting that Sullivan's there at the moment, but we can talk more about that on another day. Robert, thank you so much for counting down the NVIDIA earnings. You can pick up all the reports from the Bloomberg Intelligence team. We got an exclusive conversation with the CEO, Jensen Huang, 6:30 p.m. New York time, 11:30 p.m. London time. That is a conversation you don't want to miss. Let's stay with the earnings this time within the retail space here in the United States. Nordstrom getting a boost from the retailer. They gave a rosier outlook for their sales this year. Dasha Afanasieva joins me now. This is all about Nordstrom Rack and the guidance. Good morning.
Good morning. Absolutely. So there's a big beat on the rack portion of its stores, which of course is the discount bit. It's a bit like TJ Maxx. It has sort of boasts savings of up to 80%, and sales there rose almost 9% compared to less than 1% at the traditional Nordstrom stores. So that's what led them to increase the outlook. The upgrade actually still kind of looks a little bit conservative. I think they said, before they moved from a reduction in revenue to sort of a small increase. So judging by this quarter, that still looks conservative. But I think it's a trend of bargain hunting. So the reason why, just like TJX the other week did quite well, Target's doing quite well, it's those retailers that are signaling, this is good value, you'll get a bargain. And at Nordstrom, the other way that they're doing that and coaxing consumers in is their anniversary event, an annual event which they advertise to loyal shoppers beforehand, where they get discounts and they drive sales that way. At the same time, they are seeing consumer weakness too. They said that credit card revenues are declining because the consumer is stretched.
I do love a bargain and a pre-sale. Look, the language that we saw from Walmart a couple of weeks ago was discerning, choiceful and value-seeking. We've got more retail coming along. How much of that language will be repeated again? Who's on the rack, excuse the pun?
The consumer is sick of the gouge economy. They are stretched by high interest rates, high inflation, and any retailers that are positioning themselves to offer more of a bargain. We're talking about Gap, Old Navy, which already increased its guidance last quarter, but that also could prove conservative, looking at growth of above 4% expected for those two sub-bits of Gap. You've got Dollar General. It's also been trying to get back to basics, reduce inventories, improve stock levels. And I'll be looking for detail on whether it's using AI to do that, like Walmart, and whether that's a more efficient way to do that. And beyond the quarter, it's important to see how back-to-school spending has gone.
Nothing beats back to school. Dasha, thank you very much. Dasha Afanasieva on the retail front. Nordstrom delivers an upbeat guidance. Good morning from New York. Your front pages look a little bit like this, the headlines from around the world. First up, you got the Journal leading with the special counsel, Jack Smith, filing a revised indictment that accuses Donald Trump of trying to undo his 2020 election loss. Smith says the case remains intact, even after the Supreme Court's July ruling that the former presidents have sweeping immunity for acts taken while in office. We'll discuss that in a little bit more detail with our reporters. Up next, Washington Post reports that Israel has launched a major operation in multiple cities in the West Bank. Eyewitnesses cited drones scanning the skies and armored personnel carriers carrying troops on the ground. According to the health ministry in Ramallah, at least 9 Palestinians have been killed. Bloomberg leads on the banking front, HSBC weighing cuts in management layers. Now, the plan could see cuts in the number of country heads. Joining me now to talk about this, the overhaul. It's part of the new CEO's plan. Jenny Serrain joins me. Jenny, good to have you with us. This has all the hallmarks of what Bill Winters has just done at Standard Chartered, what Jane Fraser has been executing quite aggressively at Citi. Now, Georges El-Hedri comes in. Every new CEO wants to make their mark. And this is about taking out a layer of management, isn't it?
I think that's exactly right. And I think a lot of it is really about the environment that he's coming in. you know, this is an environment where central banks around the world are poised to cut rates. That's going to be putting a lot of pressure on HSBC's margins right as he's taking the reins. And so I think he's already trying to do you know, what he can in order to keep a lid on costs. And this is interesting from someone, you know, who's spent the last few years as the CFO of this bank. And so you kind of see him turning to a familiar playbook for him, as it were.
Well, Warren Buffett, we understand, is bailing a little bit more of his Bank of America stock. I mean, he's been chipping away at this over the summer. Now, we never really know what the motivation is for somebody like this to do or to act, to rebalance, to change their overall perspective on a stock. But it's certainly a flag to the market, isn't it?
I think that's right. And I think, you know, we actually see a lot of investors looking at their holdings in bank stocks right now, kind of trying to decide how they're going to play these next few years. So for the past few years, you've seen profits really soar, shareholder returns really boosted, higher interest rates were really good for banks for a very long time. Now that's coming to an end. And I think the question really remains, you know, can these banks navigate and do as well as they have done in a period where their margins are just necessarily going to be coming under pressure? And so to your point, we don't really know exactly what's driving Warren Buffett to bail on Bank of America, or at least, I guess, sell a small portion of his stake in this bank. But, you know, I think it's a question that a lot of investors in this space are really putting to them right now.
Well, let's be fair now. He's been long of that at $5 since 2011, and you're trading at 39.67 this morning, virtually unchanged on the back of that. So it's not a bad run. Depends where the average is. Jenny, thank you so much. Coming up, Katrina Dudley. We'll get her reaction to the move by Buffett on banks. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manus Crenny. Let's set your agenda. The macro market events. Prepare for NVIDIA earnings to deliver records and volatility. Banking blues, Warren Buffett bails on Bank of America. HSBC mulls management layoffs. And a new chapter in the election race. U.S. Special Counsel presses on with an updated indictment against former President Donald Trump. Good morning to you. Are you ready for a little bit of volatility? The options markets say you could get a swing factor of anything up to $300 billion today, depending on what NVIDIA delivers and what guidance they give you, and perhaps a little bit more narrative about where they are. We're expecting revenue to double from this time last year to nearly $29 billion. 66 buy ratings on this stock. 90% of the analysts that cover this stock have a buy rating on it. And if you didn't get in on the dip in October 2022, well, you're toast, because it's up 1,000%. And maybe you were brave enough to buy it on the 20% dip in the summer. I know I wasn't, but there you go. That is what makes a market. The rest of the market looks a little bit like this. That NVIDIA is a single macro event overall. Stocks, I can tell you this, Bank of America's clients ditched their stocks for the first time in 3 weeks last week, and they took a little bit of money out of tech. Yields still sub 390 at the moment on bonds. The two-year auction went fine yesterday. $70 billion worth of five-year paper coming today. We've just had Goldman Sachs. They quite like steepeners. They believe you're going to get 3 cuts. There's still an optionality for 50 basis points. It's almost like deja vu from every single guest that we have. I just want to get to the September rate cutting event. John Williams and Austin Goolsbee, Williams of New York, Goolsbee of Chicago, both supported cutting rates in July. And I leave you with a snapshot of dollar-yen. Again, there's more voices from the Bank of Japan. Himino saying the first job is to monitor markets closely with a sense of urgency. So don't ever dismiss the ability of the Bank of Japan to unseat your trade. As I say, investors are bracing for the NVIDIA earnings after the U.S. close, and they're betting on yet another blowout quarter. The chip maker analysts are predicting growth of 70% on average on the revenue side. Mandeep Singh is with Bloomberg Intelligence. He joins me around the desk. I mean, it just keeps on going. We're expecting records on EBITDA, free cash flow. I mean, the checklist just runs on. The alpha of that is data centers, isn't it?
Yeah, and the fundamentals look great when you think about, you know, how much they have come when it comes to data center growth. It's been really mind-boggling. And the real concern here is it's reflected in the valuation. And because the expectations have gone up so much, what can they do to really drive up that multiple, which everyone knows it's at a historical high level, and you know, further upside could come, But in the end, there is a law of large numbers that they have to deal with now with the data center business at about $100 billion run rate this year. Can you keep growing 30, 40%? That's the real question.
To keep growing at 30 to 40% is inextricably linked to the demand side from those people that have the data centers. And you and I have sat around this desk, and the market has been egregious in terms of keeping an eye on the capex of those big data center builders, which reminds me of a period of time in the mining industry when institutional shareholders were rabid about capex discipline. And we've gone through this cycle in a number of big industries. So where are we on that cycle? Because you and I have talked about the capex. Is it keeping up with the expectations of the NVIDIA growth trajectory?
Yeah, and look at the delta, right? So this year they are adding about $50 to $60 billion in data center revenue. Where is that coming from? More than half of that is coming from hyperscalers because they have told us they are raising their guide by 30 to 40%, the likes of Amazon, Meta, Microsoft. The other half is where we don't know exactly it's coming from because it's fragmented. Some of it is from sovereigns, enterprises. But there is a lot of demand simply because the market is still supply constrained. Whatever chips NVIDIA is making have a much higher ASP than their previous version of their chips. And Blackwell delays and all the other things that are risks are because of the ASPs that NVIDIA commands when it comes to the data center side.
And the thing about NVIDIA is the $31 billion in cash at the end of the first quarter. The team done the analysis. You're talking, it's like a gusher. It's literally, it's like an oil gusher of money, isn't it? I mean, you expect something like $220 billion of free cash flow over the next couple of years. So does that mean I can still look at this stock as a potential buyback stock in addition to growth?
I mean, they have to figure out what to do with the cash. They just did a stock split. Maybe they should start buying back their stock or acquisitions. I mean, clearly the acquisitions that NVIDIA has done till date have paid off big time on the networking side. The Mellanox acquisition was huge. So clearly, they are ahead when it comes to the product dominance that they have, and it will likely continue because when I look at competition, whether it's AMD, Intel has got a lot of problems that they are dealing with. There is no competition, and that's the part that should comfort investors investing in the valuation. But clearly, valuations are stretched, and any disappointed when it comes to, the upside going into the next quarter or the next 2-3 quarters will result in compression. So that's a big risk here.
Okay, well, certainly we're going to get a little bit more insight into the mindset of the CEO later on. Mandeep, thank you so much for being with us. That is Mandeep Singh of Bloomberg Intelligence. Tune in tonight. We've got an exclusive conversation with the CEO, Jensen Huang, 6:30 p.m. Eastern Time. Ed and the team, we're looking forward to that. We'll get some guidance from Jensen Huang, the man himself. My guest on Markets this morning is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. Good to see you, Katrina. How much oxygen or mind space does NVIDIA really take up for you? I mean, to deliver 1,000% from its nadir is pretty stunning. Just put that framework around for me. How important is today? We talk about it. Do you think about it?
I think we have to be thinking about it. It's such a large component of the index, and it's such a arbiter on where people are thinking about the AI spend. And I think as you just heard, the AI spend in the hyperscalers we can track and we can see what they're saying. It's that other part of the market we're also focusing on. And the AI spend there is not just the CapEx discussion, which I know on the hyperscalers is what we're really focusing on. From an AI perspective, we're actually now looking at the second derivative effect. And what does AI bring to a company? What does it do in terms of its earnings? And how is it able to accrete efficiencies to companies?
And is that something then that you translate across into when you look at the other companies, the impact, the drip down or the sort of the trickle down effect of AI in terms of delivering efficiency, in terms of delivering product innovation?
I think what we're actually looking at is how this is marrying with some of the employment data. And I think that that's the really interesting trend, because we haven't seen, we've seen the revision to the employment number that you saw, but we also have seen this thing with companies are holding on to their employees and they're not letting them go. And that was very interesting because in AI, we would have thought that there was a substitution effect, but there
hasn't been that substitution effect. And I think that that's really encouraging because it means that I think companies are relatively right-sized. Yes, you're going to hear pockets like the HSBC's laying off people, but I think relatively speaking, companies are pretty well sized for what they need, and they're going to start to see these efficiency gains come through, and that'll drive earnings growth.
I think one of the lines, actually, I can look at my phone and I put it out on Instagram. So they're coming for IQ, not EQ, which is, I think, one of the interesting aspects when we think about AI. It is that. It is Larry. It's actually Larry Summers is on my Instagram. That I just forgot. They're coming for IQ, not EQ, in the first instance. I love what you talked about the marketplace overall, and I'm going to quote you on this, which is, it feels more like Goldilocks breaking into the house of the three bears than stumbling into Armageddon. Now, a little hint of Armageddon at the start of the summer, okay? But talk me through your sentiment on that. What do you mean by that?
Because if you take a look at it, everyone is very concerned about what is the signal that's coming from these rate cuts. And there are actually two ways you can interpret one event. The first is what we call that kind of Goldilocks scenario. Yeah. Is that the Fed is cutting because they've got the room to cut. We're in an expansionary environment, and they're just making those adjustments, that kind of tinkering. And if you think about it, why is that like Goldilocks? Because it was just a little too hot, and it was just a little too cold, and then it was just right. And we think about it, that's where we think of the Fed. The other camp, and that's where you get that kind of Armageddon and you get the black side scenario, are the people who are saying, you know, these are rate cuts that are in response to an economy that is slowing faster than the market is expecting, and that we're going into a significant deceleration. And we don't believe we're going into that Armageddon. We think that we're going into Goldilocks. We think that, you know, we're landing a plane and we're trying to get back to trend growth, but it's going to be bumpy, and that's the volatility.
So it's going to be a shallow cutting cycle, this one.
Yeah, I think the market's forecasting 4 cuts by the end of the year. I don't think we're going to see quite that many. Okay. You know, the consensus was that if they had the data in payrolls in July, maybe they would have cut, but that's history.
How much of a canary, if I can call it that? We've got this story about Bank of America, Warren Buffett reducing his overall position in Bank of America. Now, you've been long the stocks for $5 since 2011, so I don't think, you know, anybody can throw a brick at him. But he is scaling back incrementally on his position in Bank of America. We don't know the reason for that. But just take that as a narrative. It either reflects net interest income is going to fall, perhaps bad debt is going to rise, it's going to be a soft landing, as you say. When you look at banks, given the scenario you've just outlined, you're obviously not that negative on banks in the scenario planning that you've got in your head.
As you talk about that scenario and walking it through. But the other thing is as you say, just taking one action by Warren Buffett and using that to construct an entire portfolio is such a difficult thing to do, because when you're sitting in the PM's shoes, you're looking at a whole lot of risks, and what are those risks in your portfolio and how they interact. And it's the same way as you sit here and we talk about the different parts of the market. It's so easy just to narrow in on NVIDIA and talk just about NVIDIA, but we need to think about those follow-on effects, and we also need to think about the other 499 stocks that make up the S&P 500. And I think that we're increasingly starting to see breadth come into this market, and that's something that we're very encouraged by. The other thing that we're starting to see is that the market is driven much more today by idiosyncratic stock returns. So about 2/3 of returns are now idiosyncratic. That's a great environment for someone like myself. We're the stock pickers, so we like to think of that, it's actually doing the work, getting your hands dirty, that will drive the returns going forward.
So on breadth then, it's interesting because the equal weight made an all-time high a little bit earlier in the week. I know that we're still sort of struggling with some nuances here about where all-time highs are, but that breadth, just expand on that a little bit for me. We're obsessed about NVIDIA today, and I think rightly so, because the market is anticipating a $300 billion swing. But where do you look for return in breadth?
Look, I think what you've highlighted, though, that $300 billion swing.
I'm glib about it, aren't I?
Yeah, it's like that's a couple of companies, combined markets. Yeah, exactly. So I think that the fact that we're just so nonchalant about the swing that could drive NVIDIA, and obviously that is going to be the driver of what happens in this market, and so we've kind of got to put that to one side, because when we talk about NVIDIA needs someone to buy their products, and that that is the rest of the economy, because NVIDIA doesn't just exist in this vacuum. So what are these other companies seeing? What are they looking at? And in terms of that, we've seen some adjustments in different parts of the sector. We've seen a little bit of weakness in the consumer, but we've seen a little bit of strength in other parts of the consumer. So I think that the rest of the market is actually doing okay. And that's what we need to continue to see, is a market that is doing okay, because to me, that is trendline growth. And trendline growth, when you've got a Fed that is cutting, is actually good.
Okay, I shan't be so glib with the 300 billion swing around factor. But you're right, but that just does show you the psychology of this market, and it can turn on a dime, quite literally. And I think we should be a little bit more respectful of it.
I think that we need to respect the market, but we also need to understand what's happening.
Katrina, thanks a million. Let's see what's delivered. And of course, we'll catch up with Jensen Huang later on today. Katrina Dudley of Franklin Templeton coming up. A fresh indictment against the former President Trump. We'll dig into how it could affect the election. That's next on Bloomberg Brief. Good morning from New York. Bloomberg Brief. I'm Manus Cranny in New York. The special counsel, Jack Smith, is pressing ahead with prosecuting former President Trump on the charges of trying to overturn the 2020 election with an updated indictment. That's following a recent setback from the U.S. Supreme Court. The Republican presidential nominee fired back at the action, writing on Truth Social. In an effort to resurrect a dead witch hunt in Washington, D.C., in an act of desperation, and in order to save face, the illegally appointed special counsel, deranged Jack Smith, has brought a ridiculous new indictment against me, which has all the problems of the old indictment and should be dismissed immediately. Kate Ackley is with us for Bloomberg Government. Kate, there are some important differences in terms of what this new indictment includes and what it excludes. So tell me what it includes and excludes that's most prescient.
It has some new people that are featured in it. Some people were taken out, because of the in response to that Supreme Court case earlier this summer that really gave presidents sort of broad, wide immunity in their official roles. So some of the people that report up the chain to the president were taken out, and some other people, consultant types, were put in. But the gist of it is really more or less the same, and it's just about the timing. This is coming out now as we're starting to move into that. We're almost at Labor Day. It's going to be the height of the election and campaign season.
And of course, you reflect back to Kamala Harris's speech at the convention, where she talked about, the power that Trump would have if he was president again without guardrails. So again, it's an interesting kind of nuance. Look, how will this crucial, undecided, the independent voters, how do you think they're going to respond to this? Because the findings here in New York, those felonies against Trump, they don't seem to have cut through at the polls. Will this more national issue cut through?
That's really the key question. I mean, we've seen over the past year, as Trump's legal woes sort of mounted, it really solidified his base in support of him. I mean, during the Republican presidential primary, these cases that came, these indictments, not just this one, but one in New York and other places, seemed to solidify support from his base. He's got his base locked in already. So now the question is, these crucial, undecided, unaffiliated, independent type voters, does this move them? And it does sort of feed into some of the stuff that Vice President Kamala Harris has talked about in her, short top of the ticket presidential run as a former prosecutor, saying, I prosecute people. And here's a contrast with former President Trump. He's been indicted, multiple times. Yeah. So that's going to be the key pivotal question, is how does this, factor into the undecided voters in terms of how they cast their ballot? And one thing that Trump, he also put something on Twitter in response to this and said, you know, the Justice Department doesn't bring political, you know, cases against presidents and political figures within 60 days of an election. Now, we're not yet within that 60 days window of election day, but what Trump was pointing out was that people are going to start voting the week after Labor Day with the, you know, early voting. So we're getting into, people are about to start casting their votes.
Yeah, it's getting close to the edge on that. Kate, thank you very much. Kate Ackley there with the very latest from Bloomberg government. Let's pivot to China. The U.S. National Security Advisor Jake Sullivan held his second day of talks with the Chinese Foreign Minister Wang Yi. This was on the outskirts of Beijing.
President Biden has been very clear in his conversations with President Xi that he is committed to managing this important relationship responsibly. We are working to ensure that competition does not veer into conflict and that we find ways to work together where our interests align.
Bloomberg's Rebecca Chung-Wilkins joins us now. Rebecca, good to see you. Do we know what topped the bill in this series of discussions, whether it was Taiwan, whether it was trade, whether it's tariffs or tech? Is there any readout so far?
Well, we are still waiting to see that readout. We know that the meeting today between Wang Yi and Jake Sullivan has come to a close. The focus, as you say, is really about trying to future-proof the relationship at these so-called guardrails. And Wang Yi and Sullivan have been meeting face-to-face over, every few months as part of what's called the strategic channel. Now, we did have some indications on both sides what they would raise. The U.S., as you mentioned, is really keen to emphasize and sort of pressure Beijing to step up its role in, withdrawing some of that support for Russia's war in Ukraine. China, for its part, has said that it's going to raise this issue of what it sees as these unfair tariffs, trade restrictions and sanctions. And it's in fact called the sanctions of its companies related to Russia as illegal. So certainly we expect that to have made up some of the meat of the conversation that's happened today.
And the significance of Sullivan's visit at this point in time, yesterday we talked about, the political tinge to this, but is that being elevated in the narrative? I mean, Biden has long been a Sinophile, so what does this say about the political timing of this?
Well, it's interesting, with Biden stepping down and Kamala taking on that presidential candidacy role for the Democrat Party, it actually means that Biden may become the first U.S. president not to visit China since Jimmy Carter. And in fact, the visit by Jake Sullivan, National Security Advisor, it's the first visit by an official in that capacity for 8 years. So there are some sort of absences in some ways that Sullivan's trip does underscore, and perhaps, of course, Biden thought he may have more time. But I think Beijing is now very keenly looking to trying to understand what a Kamala presidency would mean versus, of course, what a Trump presidency might mean.
Rebecca, I'm looking forward to the readout. Let's see what it is. Rebecca Chung-Wilkins there, tracking Sullivan in China. Good morning from a beautiful New York. From Bloomberg. It's a feast for you in terms of the trading day. On deck, we've got a little bit of Treasury auction action, $70 billion worth of 5-year papers coming down the pike. There is only one main event. It is NVIDIA. The earnings come after the market close. We've got an exclusive conversation with the CEO, Jensen Huang. That's at 6:30 p.m. Eastern Time. More Fed speak. Raphael Bostic is on the table at 6 p.m. Look, these markets are nervous. You're going to get a swing of around $300 billion on NVIDIA is what the options market is saying. Keep an eye on crypto land. This is Bitcoin, down almost 7%, the steepest slide since August the 5th. Crypto world, they're nervous.